Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Stocks moved higher from October last year through the end of July, but we're now seeing weakness in some formerly strong sectors of the market. In 2023, it's been 7 mega-cap stocks that have driven the returns in the stock market: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla. An equal-weighted portfolio of these 7 stocks is up 81% in 2023. Because they carry a high weight in the S&P 500, that index is still up 10% as well. But an allocation with equal-weighted positions across all S&P 500 stocks is down for the year, and small-cap indexes like the Russell 2000, which we consider to be a better representation of the broader U.S. economy, have also declined in 2023. Tech stocks driving the performance of the market is not a new trend. If you look at the total return of each sector of the market during the past 5 years, the only one that has outperformed the S&P 500 has been technology. Owning tech has been a huge winner for investors since 2009, but we caution anyone who thinks that this trend will last forever. In every decade going back more than a half century, there has been a theme that generated big returns. It's ranged from commodities like gold and oil, other parts of the world like Europe, Japan, and emerging markets, or growth in tech stocks in the US. The key point is none of these themes lasted for 20 or more years. We're already almost 15 years into the current theme. It doesn't mean avoid technology stocks. It means to continually look at markets with a fresh perspective and maintain balance in your portfolio. This is a tricky time to have a lot invested in those magnificent 7 stocks at the top of the market because there's already high growth expected when you look at their price to earnings ratios. The average is 28 times earnings. Not all of the 7 stocks have such high price to earnings ratios. Alphabet and Meta trade at less than 20 times earnings, which appears reasonable to us. But the others are above 25 times, a good distance away from the 10 to 20 times earnings that we've seen their valuations fall to at bear market lows. We're starting to see weakness in these market leaders. Tesla looks the most vulnerable to us. Tesla has declined by 26% in the past 3 months, yet it still trades at 50 times earnings. Next, Nvidia is the most volatile of these stocks, and Apple has the most growth concerns. Amazon, Meta, and Alphabet actually trade around fair value in our estimation. They can still decline more if we enter a bear market, but that's why we believe they have outperformed in recent months. Microsoft could definitely decline more, but it also has the strongest fundamentals right now, so it would probably be the last of the market leaders to break down. We're also seeing the formerly strongest areas of the stock market start to break down. Semiconductors and home builders have both declined by 15 to 18% in the last 3 months. Bank stocks are on the verge of falling to new lows, and small cap stocks are really struggling. This is a 3-year chart of the Russell 2000 small cap index. Normally, after the market makes a major low, small cap stocks appreciate by 50% or more in the first year. In this case, the Russell 2000 is back at its low from 2022. That bodes poorly for a market turnaround and suggests there is more weakness ahead before we truly reach a bottom. There are numerous indicators we track to help us decide whether to be more aggressive or more cautious in our clients' portfolios. It's rare to have all of those indicators pointing to caution, but that's the case today. Here's one example. David Rosenberg has a simple model with 10 yes or no questions to determine the momentum of the stock market in the near term. These are questions like, is the S&P 500 price higher or lower than its average of the past 2 or 9 months? Are expected profits rising or falling compared to a few months ago? Are junk bonds performing better or worse than they did earlier in the year? When this model is at an 8 or 9 out of 10, stocks tend to drift higher in the near term until some of the metrics return to a more neutral level. Today, it's the opposite. We are at a 1 out of 10, which tells us to be careful because any unexpected moves in the market are more likely to be negative rather than positive. We hope that gives you a sense of why we continue to be defensively positioned in our clients' portfolios. If you have any questions or would like to learn more about Oxbow, please contact us. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.